Hey guys, Barry Page here. Thank you for joining me for another episode of Legacy Money, the show that helps you live more, give more, and leave more. This video is all about financial education, self-education, things that are not taught in school. And today we're going to talk about the alternative to investing. If you want to reduce your risk, reduce your taxes, reduce the interest that you pay to others, then you can use whole life insurance to do that. It's called whole life insurance for a reason. It's available to you over your whole life. You can use it to store capital. You can use it to distribute capital. You can use it to create generational wealth. And although the name has been misused or misconstrued over time, traditional whole life insurance is available to you over your whole life. The premiums are level, they're guaranteed. You can use it to make your other assets better. You can use it to reduce your tax liability. You can use it to avoid paying interest to others. So make sure you stick around to the end and I'll make a comparison for you so you can look at how your investments or your other assets will perform better just by owning life insurance. All right, so let's get started. I want to specifically today talk about whole life insurance. It's not an investment. It's an alternative to investing. It can make your investments better. For whatever reason, especially in recent years, life insurance has been compared to other investments. Now, there are many other investments, as you know. They could be stocks, it could be real estate, it could be crypto, it could be precious metals. There's many ways to invest your money. Maybe it's business. So let's start by saying that life insurance is a financial tool. It's a multi-tool. Think of it as a Swiss Army knife. It's an asset that provides protection, savings, and growth. So your dollars work harder. They have multiple uses. If you want to use the cash flow that is available from a whole life insurance policy to purchase investments, you certainly can. And if you already have other investments, when you get ready to spend those, to take that as income, it will make them perform better. Specifically, I'm talking about a participating, dividend-paying whole life insurance policy from a mutual carrier. What does that mean? That means a mutual insurance company is owned by its policy owners. Now, there's only a handful of these companies, and there are literally thousands of life insurance companies. So unfortunately, these other companies, these stock-based companies, meaning they're owned by stockholders, they've come out with all sorts of products over the years, starting with universal life. Then there was variable universal life. And today there's index universal life. Now, unfortunately, these products are compared to investments. So you can see how there is confusion in the marketplace. To eliminate some of this confusion, we'll talk specifically about dividend-paying whole life insurance from a mutual company, a mutual carrier. Just be aware that when you see all of these TikTok videos and YouTube videos or Facebook videos that are comparing life insurance to an investment, these are not the types of policies that I'll be discussing here with you today. Life insurance is not an investment. It's a financial tool that you can use in whatever way that you'd like to while you're alive. I'm talking about whole life insurance, the kind that's been around for centuries. It provides protection, first of all. It protects you from risk should you die too early, immaturely, or if you live too long, if you have a long and prosperous life, which is what we hope happens, then you'll be able to use it while you're alive. Life insurance is unique. It's the only financial product that can stand completely alone. No other asset offers the benefits of whole life insurance. Most other assets involve risk, and if not, they involve management. So you may have to pay additional fees to have someone manage those assets. These costs can be substantial over time. The beauty of life insurance is that you can own it, you can control it on your own. There's hired help at the company. So if ever your agent went away, you can always deal directly with the company. The company has been around for centuries, so it's not going anywhere. And if you're familiar with the safe withdrawal rate, the 4% rule, well, this has changed over time, and they no longer say that it's a safe withdrawal rate, but we will assume a withdrawal rate. Just understand there's different, if your money is tied up in most assets, real estate, stocks, mutual funds, that they're going to perform differently year to year. The life insurance may perform differently year to year, but that's why it has guarantees to level that out. The other assets, there's a sequence of returns risk. So one year might be better than the other years. And if you continue to withdraw during those down years, those bad years, you can deplete the asset. You could run out of money. Life insurance can provide a buffer, a safety net when you're taking distributions from your other assets in the down years, in the bad years. So you can level out, you can have a guaranteed income. Another feature or benefit that it provides along with the protection is savings. It's a way to save your money in a system that you can own and control. You'll participate with the company. They provide all of the means, all of the mechanics to make this thing work. They have actuaries. They've built these policies for centuries. So they understand how it works. And you don't really have to know all of the mechanics of how they work, but just understand they've been engineered to perform better over time. So the longer a policy is in force, the better it will perform. These policies provide growth. Over time, they will grow, guaranteed. They're based on mortality. And again, these actuaries designed them with this in mind. This allows for a efficient growth of your money over time. Your policy will grow, and you can use it by taking policy loans, by taking surrenders, whatever method that you choose, you can utilize the cash value that grows within the policy. Where a term policy or some of these other hybrid policies, the death benefit remains level, the death benefit will actually grow with a participating policy. There's a guaranteed growth that's just based on the life of the policy, the mortality, that will get better every single year. These participating policies, again, participate through dividends. Now, dividends are not guaranteed, but most of the carriers that are mutual companies have paid dividends for over a century. And specifically, the companies that I like to work with have been paying dividends for 150, 200 years every year through ups and downs in the marketplace. So again, the dividends are not guaranteed, but once a dividend is paid, it is guaranteed. It's in there. It's not going to go away. You cannot lose the money that's in the policy. So as long as you're paying the premiums put forth in the schedule when the policy was put in force, then they're not going away. They're not going anywhere. And you can choose to pay premiums as long as you like. There's many ways to structure a policy, but the base premium is guaranteed to remain level for the life of the policy. So your policy will grow efficiently over time, and you'll be able to enjoy the benefits that are built into your policy. There's protection from loss, there's savings, and there's growth. There's many other benefits depending on how the policy is structured. Again, there's riders, there's waivers of premium, there's long-term care benefits. There's lots of ways to utilize your policy and to have your money grow over time efficiently and effectively, and ways for you to utilize your policy and have access to the capital, the cash value that's inside the policy. So primarily, there's a reduction of risk from day one. If you're looking for a way to save more money, then this provides a nice alternative to risk in the marketplace, or just storing your money at the local bank where it may grow, but if you could get a competitive rate with more benefits than at the local bank, then that's what this can provide for you. While there are many alternatives to traditional investing, which most people know of as stocks, mutual funds, it could be oil, it could be options, it could be some other strategy, real estate, commodities. There's many ways to invest your money. The problem is these other investments involve risk. And so what I'm talking about is not an investment. I want to talk to you about safe alternatives. Life insurance happens to be one of them because it's been around for centuries. That's why it's safe, because again, it's designed by actuaries and it's designed to avoid risk. One other safe alternative could be annuities. Now, again, there's many flavors of annuities, but understand that annuities are a life insurance product designed by the same people who designed the life insurance. And if you really want to avoid risk, you'll own both life insurance and annuities. Some people may not qualify for life insurance because you do have to qualify. You have to be approved through underwriting. This underwriting might be medical underwriting. It's also financial underwriting. And they just want to make sure, the underwriters, that the risk is not too large for them to take on. Back to the mutual company, as a mutual policy owner myself, there is a risk pool, and we want healthy people in the risk pools. So we're not taking on unnecessary risk. Now, I'm not necessarily an underwriter, but my job responsibility, my job description calls for me to do some field underwriting. So during the process of application, we may uncover some risk to the insurance company. And so, we'll discuss those if you were to go through this process working with me, with our agency. But we would choose then perhaps a company that could take on these risks, these additional risks. And, they could just come from your lifestyle. You could jump out of airplanes. You could be a race car driver. You could be someone that works on power lines. So these are risks that the underwriters would have to consider when underwriting you for life insurance. It doesn't matter the company. It doesn't matter the type of company. They all have underwriting guidelines. So again, these underwriting guidelines might be health. You could have cancer. You could have diabetes. You could take prescription medications. And sometimes these are not an issue, but other times they are. The more severe the health concern, the more underwriting that there may be. Annuities and life insurance provide a safe alternative to traditional investing. These are places that you can store and distribute your money, your capital, back to you over time. These time-tested products provide fixed returns and guaranteed results. You can shield your assets from predators and losses. The only reason I bring up annuities in this video is just to let you know Perhaps, again, through the underwriting process, you were not able to get approved for life insurance. But then you have other options. You can have an insurable interest in someone else. Perhaps it is a family member, a business partner. There's many ways that you can apply and utilize life insurance. However, annuities work somewhat like a pension. So if you have a large amount of money and maybe you're later in life, and when I say later, after age 65, maybe you've retired from working or you're no longer working and you have a large amount of money, and you now have to distribute that, use it as income, then a guaranteed annuity can provide you with that. And it's real simple. It just provides income for life. You can't outlive the income. So life insurance and annuities work. They have some of the same benefits, but they do work a little differently. The life insurance is mainly while you're in the accumulation phase, and think of annuities as distribution. However, if you buy life insurance when you're younger, you can certainly use it for distribution later in life. And because they're offered by life insurance companies, you can often get them from the same carrier. You may want a different carrier. It's totally up to you, but they do work well together and provide safe alternatives to investing. So when you get to that time in life where you're no longer working and you don't feel safe or comfortable having your money in the markets, they can provide you with a different place, a safe alternative to those investments. With life insurance, everything is built in. The actuaries, the underwriters, all of these things have been baked into the cake, into the pie. So you know what you're getting from day one. There are no additional fees from working with most agents. Now, some advisors may provide other financial asset management as well, so they may charge you a fee for their services, and that's fine should you go that route. Just understand that the fees are already included in any life insurance product to begin with. Now, you can't say this about these universal life products because these fees are variable. They can change over time. That's why there's more risk involved with these other products. So let's take a look at an example. Let's call it man A and man B, person A, person B, however you want to look at it. We'll compare owning life insurance at retirement time, passive income time, or later in life, to not owning it, to maybe someone that bought term and invested the difference, and now the term is no longer available. So let's look at an example of how life insurance can be used later in life during retirement. Now we have to start out with some initial assumptions. So we're just going to say that this person was going to retire at age 65, and we'll give them a life expectancy to age 89 with an inflation rate of 3%. And let's say their nest egg grew to $2 million. Now this would be taxable, whether it was a mutual fund or an IRA or whatever the case may be, but taxes are now due on the distributions. We'll say maybe they've chosen a little safer portfolio at this time. Maybe it's 5%. Could be more, could be less. Typically, people get a little more conservative with their investments at retirement. We'll assume they're in a 25% retirement bracket, tax bracket. Here are the assets, $2 million at 5%. That would provide an income of about $100,000 a year distribution from that asset. These types of assumptions, traditional retirement planning, Monte Carlo, is that you hope to never touch the principal. The legacy would be the asset if you did not have to spend it. But there are risks. There's major risk involved with this type of planning. First of all, there's taxes. We don't know what tax rate you'll be in. We're assuming 25%, and that's $75,000 that would be available to you or this person A for spending. There's inflation risk. We don't know what that $75,000 will buy at this time. There's interest rate risk. So if a person were earning 5%, it may be less at this time. And of course, there's the loss of capital. You could lose the capital. Market risk. If the markets go down or wherever this investment is, you could lose money. And then there's longevity. What if somebody lived longer than 89? What if you lived to be 100? All right, so let's look at an option, an alternative. So if you were able to spend the money without fear of running out of money, then you could take $141,905 in this same example at 5%. The reason you could do that would be because you have cash value life insurance at this time, whole life insurance as we're discussing. So the legacy is the insurance, the cash value insurance, the whole life insurance would provide that death benefit upon this person's death. The cash value could be used in the down years whenever maybe the market did not perform or wherever this asset is, the business, whatever it might be, were not performing as expected. So it mitigates the risk. So it mitigates the tax risk, and in this case, assuming the same $25,000 taxable, and I'll show this in more details later, the net would be $116,905. It mitigates inflation because this asset is growing over time. It mitigates the interest risk because, again, if that asset did not perform, then you have something as a buffer to fall back on. If there's a loss of capital, it mitigates that risk because you still have the asset, the legacy of the cash value life insurance. It mitigates market risk and longevity. If you live too long or if you die too soon, the life insurance is there. So you can spend the asset. Whatever asset you have, you could spend it all. So let's compare alternatives. On the left here, conserve principal, we'll call this person A, and on the right, consume principal, we'll call this person B. The consume principal is the alternative to distribution of income at, let's call it retirement time. Age 65, so these are shared assumptions. On the left, conserve principal. This person had term insurance, which expired at age 65. The person on the right owned cash value life insurance, whole life insurance. They had the same scenario, $2 million with total assets, but they also owned $2 million of life insurance. The only difference is the person on the right, person B with the green, had whole life insurance when they retired. The person on the left had term insurance when they retired, so it was going to expire. Here, you see the sum total. This person was able to have a gross withdrawal total of $2.5 million, 25 years at $100,000. The taxes on that were $625,000, so they netted $1,345,000 after taxes. Now, I'm going to show you all of the numbers, so inflation is cooked into this as well. So over here, this person was able to take a gross withdrawal of $3.5 million, $3,547,623. And their average tax rate was 10.91%. So they paid $386,906 in taxes for a purchasing power net of $2,241,928. The delta, the difference, was 69%. That's again assuming this person lived to age 89, and just the difference by owning the life insurance. We haven't spent the life insurance. We're using it as a legacy. This person over here conserved their principal, and that would be their legacy. Whatever is left over, did they not have to spend it? And again, we have to assume that they got 5% every year. But let's look at all of the numbers. So here you are, age 65, This person, A, $100,000 gross withdrawal, that is 5% of $2 million. They had to pay taxes on that, $25,000, so their purchasing power after taxes was $75,000. This person was able to withdraw $141,905. They still paid the $25,000 that first year. The purchasing power, though, the net was $116,905, a difference of 56%. Now you might be saying, why was the tax rate lower? So the first year the taxes were exactly the same, they just took more. Now the second year, everything is the same on the left every year, if you notice. There's $100,000 every year through age 89. 25%, assuming taxes never change, taxes are the same. But what you do see is the purchasing power going down, and that's because of inflation. We're assuming 3% inflation. So you see at the end, the $1.3 million is what they were able to spend. They paid $625,000 in taxes. Let's look at person B. Person B was able to spend all of the principal. They didn't have to worry about running out of money because they had life insurance. So $141,905 is what they took every year. They just equaled it out over that time of 65 to 89 over that same 25 years. But what you'll notice is the actual tax rate is going down every year, and the taxes paid $1,689, so the purchasing power was $68,977. We're assuming the same inflation on both. After the 25 years to age 89, and the sum $2.5 million versus $3.5 million. We'll round it off. The delta, the difference, 69% over time. Which would you rather have? Owning permanent, whole life, cash value insurance at retirement time or not? If you had term insurance, it's going to go away. It was canceled. You either could not afford to pay the premiums or it expired at that time. Over here, you had cash value life insurance. Now, I want to show you one other thing, because if you wanted an inflation hedge over here, you may be able to take a little less in the beginning. This is a drastic difference between 141 and 100,000. Let's say you wanted to just use the life insurance to fight the inflation. Well, then you might increase that over time. So 115 the first year, 117 the next year. Again, then you have an equal amount every year after inflation. Okay? So that gross withdrawal increases over time, and the purchasing power stays the same even with inflation. So at the end of that time, this person, with the inflation adjustment on there, in other words, they took a increasing amount every year to combat inflation. Now we have 3,729,165. 432,000 in taxes paid versus 625,000. So they actually paid less in income taxes because they were able to consume the principal, because they had life insurance, whole life insurance as a buffer. That's $2.26 million that they were able to use out of the $2 million with the inflation hedge. So it's a 76% difference over person A that conserved their principal. They didn't want to run out of money. Now, they would still have the $2 million that they started with if things did not change, right? But this person had the life insurance. We're assuming the life insurance never increased in value because this particular calculator can only show it that way. But whole life insurance, dividend-paying whole life insurance from a mutual company would actually increase over time. And again, you don't have to worry about running out of money. Person B could consume all of the other assets because they had life insurance to provide the legacy whenever they passed. What if they lived to be 100? The difference is even greater. So the longer you live, the better the life insurance gets. 4.8 million gross withdrawal. Person A, if you live to be 100, would take 3.6 million. That's assuming 36 years. They live to be age 100. Person B that was able to consume this asset without fear of running out of money was able to take 4.8 million. 53% difference in purchasing power over time. By owning life insurance at retirement age can provide you with a peaceful, stress-free life because you don't have to worry about running out of money. You can consume the principal. Now, if for some reason you wanted to spend the life insurance, you could. But in this example, you're not spending the life insurance. It's just a buffer. It's a fallback. It's a safety net should this asset not perform at 5%. So you still had the same assets. You were just able to spend more. You had more purchasing power. You paid less in taxes. So I hope you enjoyed that example of person A and person B, the comparison between being able to consume principal and conserve principal, and less worry, more confidence. I hope you learned something today. Again, this is purely self-education, things that most agents don't know or won't take the time to share with you. So share this video with the people that you love and care about. Share it with those who maybe don't quite understand life insurance and you want them to learn. Share it with those who have told you life insurance is a bad investment or it's not a good place to store your money. I have lots of videos on whole life insurance and how you can use it and all the benefits of life insurance. So be sure to check out those other videos and please leave your questions and comments. So I hope you enjoyed this video. If you did, please give me a thumbs up and subscribe. That helps the YouTube algorithms. That helps me to serve you more so I can produce more of these videos.